Canada's housing market has shown flickers of resilience, but we're still navigating what could be the largest correction in Canadian history. Home sales have climbed for 5 straight months since April's low, yet prices remain relatively soft. The GTA and Golden Horseshoe face the toughest conditions: lack of affordability, condo oversupply, and layoffs in manufacturing, while the prairies, Quebec and Atlantic Canada, show steadier balance and modest price growth. Welcome back to helping you build wealth through real estate, brick by brick. My name is Nico James-Bock, and I am here helping you make sense of today's market so you can build smarter wealth through property. Coming up next, I'll break down the September 2025 TREB market stats and show how these shifts affect your strategy moving forward, and also where the real opportunities lie. First up, the GTA snapshot. Toronto saw a brief pause in August, then sales were up 8.5% month over month in September. But prices remain below 2024 levels. The sales to new listings ratio, less than 40%, confirms a buyer's market environment. Condos continue to outperform 7% year-over-year price index, though detached homes also softened. High-quality listings, such as corner semis in, for example, Nobleton, Vaughan, still attract multiple offers, showing demand for well-positioned product. Also, unique condo units, those that are soft lofts or hard lofts, the unique layouts and positioning of those buildings are often the first to sell when other cookie cutter condos or condos in more problematic areas languish on the market. Rising inventory and days on market, coupled with seller price realism, suggest an ongoing adjustment phase. I have the charts on screen for those that are watching this podcast on YouTube. It shows the monthly as well as the 3 previous years for comparison in terms of MLS sales. What's interesting to note is that July, August, and September, those periods often show the least variation in terms of sales, showing the trends continue over the summer months, have held firm. Market shifts and inventory trends. So surge in new listings across most categories, except 905 townhomes, show elevated supply and extended days on market. More sellers are adjusting their price strategies as buyers re-enter the market. Buyer urgency, however, remains low, though activity may rise ahead of Thanksgiving before the usual holiday slowdown. The market correction could extend for years. This is just the reality, mostly because of the record number of completions in 2025, as well as buyer apathy and obviously the tariffs leading to a lot of uncertainty. This is offering buyers opportunity while motivated sellers can still transact successfully. One of the 7 factors that affect house prices is the cost of ownership. So this is a quick mortgage and rate update. Uninsured fixed rates eased, so 3-year fixed rate are averaging 3.94%, whereas the 5-year variable is hovering around 3.99%, so just under 4%. The Bank of Canada cut its policy rate to 2.5% on September the 17th, and is expected to cut one or two more times at the next announcements. The next announcement being October 29th, so in a couple of weeks. And the final meeting of the year is on December the 10th. The BOC proposal to exclude mortgage interest from CPI faces skepticism. Higher rates still mean raising shelter costs. So two further cuts, as I mentioned, may be required to restore real momentum. The calendar for the Bank of Canada, if we look at what has taken place in 2025, we started January 29th, to be specific, with a policy rate cut by 25 basis points, bringing it down to 3%. Then there was another rate cut on March the 12th, another 25 basis points, bringing it down to 2.75%. There was a rate hold in both the April 16th and June 4th as well as July 30th announcements. The last announcement on September the 17th saw the rate cut 25 basis points to bringing it to the 2.5% that we are seeing now. The economic backdrop is showing that the GDP contracted 1.6% in the second quarter of 2025, which is the largest contraction since the pandemic. I mean, unemployment losses are over 100,000 in July and August combined, and the jobless rate is sitting at 7.1%. Inflation pressures are cooling. So core inflation is at 3%, whereas if you include shelter costs, it's down to 2.6%. Exports, business investment, and construction remain weak. Excess capacity is rising. The BOC concerns, well, it's persistent core inflation versus weak growth. Most expect a fairly restrained stance ahead. Population and labor dynamics. These are also factors that affect property values. Immigration plan has been revised, slightly lower population growth in 2025-2026 before rebounding in 2027. We'll see how that plays out in terms of the absorption of the record number of completions over the next several months and the standing inventory of resale units. Shortage of skilled labor continues to limit construction capacity amid an aging workforce. Market's structural imbalance between labor supply and housing demand remains a long-term constraint. We look for the new financing alternatives that were announced, offering more opportunities. The introduction of the Home Equity Sharing Agreements, HESA, investors fund owners for a future share of appreciation. Similar to our borrow, which is another option. No monthly payments in this scenario, no credit impact, and simpler approval than HELOCs, gaining traction among equity-rich but cash-limited homeowners. So the cost of ownership mortgage update. Pent-up demand plus motivated sellers equals gradual stabilization ahead. Affordability will remain strained despite these lower rates. 225 equals rebuilding confidence. 226, a return, albeit slow, to growth. Market professionals should focus on guiding clients through a data-driven shift rather than short-term swings. That is the advice that I am giving my clients, rather than look at the short-term swings. They are encouraged to look at data-driven shifts in the marketplace. The data is showing that there is another shift. We are seeing slightly more confidence, but it's measured because of the incessant tariffs and the uncertainty around those tariffs. Optimism is measured, it's tempered, and it often oscillates between being high and being low. So we'll see how the next few weeks play out. We are deep into the fall market, which is typically one of the busiest markets. I suspect it will not be as busy as past markets, but we'll see what the next announcement holds for the marketplace. 2026 will be a rebuilding year as confidence gradually returns and stronger demand emerges into the second quarter. Innovation in financing, such as the home equity sharing agreements, is offering new paths for homeowners to access equity without monthly payments or credit impact. While this correction may take longer than many have hoped, it's creating real opportunities for buyers to act strategically and for sellers to reposition, reset, and still succeed in a market finding its new rhythm. If you found this information useful, then please like this podcast and or leave a comment. I'm interested in hearing what you have to say, what your feelings are as we head deeper into fall and as winter approaches. Please share this episode with anyone who may find the content useful. Once again, my name is Nico James-Bock, and I am a broker with Keller Co-Elevation Realty and founder of the CondoWiz. Ciao, ciao.